Good morning, students. Today we are going to learn what is capital structure. In my previous video, I had explained you which are the different sources available for raising the capital. Now, capital is the amount of money which is invested in a business. Now, there are different sources through which we can raise the capital depending upon the need. If we need the capital for shorter period of time, it is known as working capital, which is used to meet the daily requirement of the business. On the contrary, if we need the investment for longer period of time, which is made in fixed asset, it is known as fixed capital. So depending upon the requirement, there are different sources available. For example, we have seen about equity shares, preference shares, term loans, debentures, leasing, hire purchase. These are the sources through which a businessman can raise the money in the form of capital. Now we will understand what is capital structure. Capital structure is making a decision about how much percentage or how much amount of capital should be raised in form of equity and in the form of debt. That means how much capital is to be invested in the form of owned source and in the form of borrowed source. So as we can see, capital structure refers to combination or mix of debt and equity which a company uses to finance its long-term operations. So if you want to raise the capital, say of 10 lakh rupees, so in that 10 lakh rupees, how much would be invested in the form of equity, in the form of preference or in the form of debentures, that decision making is known as capital structure. So capital structure is raising of capital from different sources and their use in different assets by a company. Now very important point that is to be considered, that the capital which is raised should give you maximum return at a minimum cost. So that is going to give you a optimum capital structure. Now, which are the different forms or patterns of capital structure? So, organization can raise the amount completely in the form of equity shares, or it can be a mix of equity and preference, or it can be a mix of different proportions of equity and debenture, or which is also known as debt capital, or a company can have a capital structure in the form of equity plus preference plus debenture. So depending upon the choice, need and the company's position, company can have any of this pattern as a capital structure. Now we are going to see which are the determinants that helps a business person to decide the capital structure for the organization. The very first factor or determinant is tax benefit of the debt. Now, as we all know, we need to give returns to our investors. Dividend is paid to shareholders while the debenture holders get the interest from the organization for their investment. So the interest which is paid to debenture holders or to the debts, that is tax deductible. So if the organization wants to avail the benefit of tax, they can use more debentures in the capital structure in compared to equity. So when the tax rate is high, firm will prefer more of debentures over equity or preferences. Next factor is flexibility. Now flexibility means firm's ability to adjust its capital structure. As we all know, equity is a permanent source of capital, so we cannot redeem the principal amount back. On the contrary, debentures are redeemable in nature. So if we need to have the room for adjustments, the company would prefer more of debentures in comparison to equity so that it can have the flexibility in capital structure. The next factor is control. Now, as the shareholders are the owners of the organization, they get the control in the proportion in which they have made the investment. So, if the management does not have the mind sharing control, they can use more of equity. But if the management or the owner of the organization needs the control in their hands, they are going to prefer more of debentures. So depending upon the management need of control, they are going to decide whether to go for more of equity or for debentures. Next is seasonal variations. Now, if you are running an organization or if your product is seasonal, in that case, don't prefer for issuing more of debentures, because if your product is seasonal, you won't be getting enough of profit during lean period. In that situation, it becomes difficult for the organization to pay the interest to debenture holders on regular basis, or you are not able to repay the principal amount, so it may lead you to insolvency. So if your business is seasonal in nature, issue more of equity over debenture, and if it is non-seasonal, go for more of debentures. Next is a degree of competition. If there is more competition, if similar products are available in the market, in that situation, earning of profit may be lowered, because of which you are not able to give the returns to your investors. In such situation, usage of more equity is preferable. On the contrary, if the competition is less or if you have monopoly for the product, you can have more of debentures, because profit is high, you are able to pay the interest to your debentures, and you are able to repay the principal amount back. So depending upon the competition, you can decide the proportion of equity and debentures. Next is industry life cycle. Now every organization passes through four different stages during its life. First is introductory, then growth stage, maturity and decline. Now during introductory stage, company does not earn enough of profit. So in such situation, company should rely more on equity in compared to debenture, and as it reaches to growth or maturity stage, they can earn enough of profit and they can have more of debentures in the capital structure. Next is agency cost. Now, many times there may be conflicts between shareholders, debenture holders, and management, which may lead to conflicts in these agencies, and it involves agency cost. So, if the shareholders are demanding, or if they feel that there is more risk if company would have debentures in the capital structure, they are going to demand more of dividend. Similarly, there might be the conflict between shareholders and debt holders. It arises because of possibility that the shareholder may transfer the wealth to debt holder on their own favor. So if such conflicts arise, it is a problem for the businessman. So all the factors are to be taken into consideration. What are the management's objective, what shareholders expect, and what debenture holders are expecting from the organization. Depending upon that, the organization should follow a proper financial strategy so that they can get maximum returns on their investment. Next is size of firm. If the organization is small, such firms or such small organization rely on more of owned fund, because their scale of operation is small, because of which profit is low, and if they issue more of debentures, it is possible they may not be able to pay the returns to the debenture holders. On the contrary, if you have large firms, you are forced to make the use of different sources of fund, because a single source is not sufficient to meet the needs of the large scale operation or large firms. The next determinant is period of finance. Now, depending upon the requirement for what time or for what period the finance would be required, the organization has to take the decision. Now, equity capital is a permanent source of capital. So, equity share capital is the best source when you need to have the finance for unlimited or for longer period of time. And if the finance is required for limited period, then you can rely more on redeemable preference shares or redeemable debentures. The next point is purpose of finance. Now, why you need to have the finance? If the purpose is productive, for example, if you are purchasing some assets or machinery so that you can start with the production, then in this case issuing debentures is suitable for the organization, because after production of goods you are going to sell it and you are going to get profit, which can be used to pay the interest to the debenture holders. On the contrary, if the purpose of financing is unproductive, for example, if you are raising the finance for carrying out CSR, that is corporate social responsibilities, or for expansion, in such case equity share is more preferable because you are not generating profit out of these activities. So in this case, relying more on equity is preferable. Next is credit rating characteristics. Now, credit rating, if the organization gets good credit rating, definitely investors are going to prefer such organization, and easily firm can raise huge loans or investment from the market, because credit rating is more, that means you are able to repay the principal amount, you can give the returns on regular basis, because of which the investors feel the risk is less and they are preferring the organization. So depending upon the credit rating, the firm can decide the investment. Next is timing of public issue. Now, depending upon the economic conditions, the organization has to decide which source is preferable. Now, if the economic conditions are good, definitely you can go for more of debt, but if the economic conditions are not good, you should rely more on equity shares. Next is requirement of investors. Now, again, what kind of investors are available in the market, that helps the organization or a business person to decide the capital structure. If you have the investors which are ready to take the risk, then you can go for more of equity. But if there are investors who wants to play safe, who wants the stable returns, or who are conservative in nature, then you have to raise the capital in the form of debenture. So depending upon the investors, you have to decide either for equity or for debentures. Next is legal requirements. Now the company has to follow the guidelines which are given by the SEBI. Now, according to SEBI, mostly the proportion for debt to equity should not exceed 2 is to 1, or the debt for, or the ratio for preference to equity should be 1 is to 3. So the company has to abide to the rules and regulations laid by the SEBI. Next, cash flow position. Definitely, if you have more cash inflows, you can rely more on debt. If there is a shortage of cash flow, you cannot prefer more of debentures, because you are not able to pay the returns, and it is mandatory for the organization to pay returns every year to the debenture holders. So in that case, relying more on equity is preferable. Next is interest coverage ratio. Now it can be found out by dividing earnings before interest and tax, that is the profit, divided by interest. Now this ratio means number of times company's earnings before interest and taxes cover the interest. That means it shows that it shows the ability of the organization to pay the interest to the debenture holders. That means if you are earning enough of profit, you are able to easily pay the interest to the debenture holder. So when the interest coverage ratio is high, preference would be given to debenture, and if it is low, equity is preferred. Similarly, debt service coverage ratio also shows the capacity of the organization to cover the interest of the debenture holders. So if this ratio is high, again go for more of debt. On the contrary, if it is low, go for more of issuing of equity shares. Next is return on investment. If your return on investment is more in compared to rate of interest, that means the percentage of returns is more in comparison to the percentage of interest to be given to debenture holders, you can prefer to have more of debentures in the capital structure. But if the interest if the returns which you are earning on your investment is less in comparison to the interest which is to be paid to the debenture holders, in such situation you should rely more on equity shares, because paying dividend to equity shareholders is not mandatory. So even if you are earning less on your investment, still it is okay for having equity shares, but in such situation debentures are not going to work for you. So depending upon how much returns you are earning, you should decide whether to go for more of debentures or for equity. Next is flotation cost. Now the cost of debenture, that means the amount you are giving in the form of returns to debenture holders, is mostly less than the amount of or the cost of equity. So it may influence the decision of finance manager, and definitely the finance manager is going to use the cheapest source of finance, which is debt. Next is state of capital or stock market. Now what is the share market condition that helps the organization to decide the capital structure? If it is having a boom period, that means if it is in a growth period, definitely the business is going to flourish. If business is flourishing, definitely there would be more demand for the securities, prices are going to rise, and easily you can issue the equity. On the contrary, if depression is there, slowdown is there, risk is high, the market price for securities are going to lower down, there won't be any demand for shares, and in such situation the company has to rely more on debentures. So depending upon the state of capital or the stock market, company has to decide whether to go for equity or for debentures. Next is risk. Now, every firm has to bear two types of risk. First is financial risk, and second is operating risk. Financial risk means whether the company is able to meet its fixed financial charges. That means the interest which is to be paid to the debenture holders. If the company is able to pay the interest every year regularly, financial risk is low. But if it is not able to pay, it increases the financial risk, and company has to wind up and then make the payment. Operating risk is related. Operating risk arises when the company is unable to meet its operating cost. So depending upon the risk, if the risk is low, issue more of debenture. If the risk is high, you can issue more of equity. Capital structure of other companies. If the now in the same industry, company has to look after the capital structure of other companies which are there, and on similar ground the finance manager has to take the decision, and then the capital structure is decided. So depending upon the capital structure of other companies under same industry, a firm has to take the decision between investment of debt and equity. So these are the factors which help to decide what should be the capital structure of the organization. Thank you.